The Federal Reserve dropped a new report this morning. The headlines are already calling it doom, but the actual numbers tell a story most people are missing. Total household debt in this country sits at $18.8 trillion. That sounds enormous, and it is, but it only went up $18 billion last quarter, the smallest jump in over a year. Credit card balances actually went down, and the part of the report nobody is leading with is the part you need to hear. So today, I'm going to walk you through what the Fed actually said in plain English and what it means for your money. Before I go any further, I want to say this clearly. I am not your attorney, your accountant, or your financial advisor. Nothing in this video is legal advice for your specific situation, and the rules change depending on what state you live in and how your accounts are set up. If you are dealing with debt problems right now, please talk to a nonprofit credit counselor or a free legal aid clinic. What I am sharing comes from over 20 years of watching this exact data from inside the bank. Use it as a starting point. Let me start with the surprising part. Most of America is holding the line. The overall delinquency rate, which is the share of all consumer debt that is behind on payments, stayed flat at 4.8%. Credit card balances actually dropped by $25 billion, the first quarterly decline in a long stretch. Mortgages grew, but only by $21 billion, which is small. If you were expecting the report to say the economy is on fire, the data does not say that. It says the average household is treading water, not drowning. Now, here is the part the Fed is flagging as a warning. Student loan delinquencies are the loudest signal in the report. 10.3% of all student loan balances are now 90 days or more behind on payments. That is up from 9.6% at the end of last year. 2.6 million borrowers were referred to the Department of Education for default collection in the first quarter alone. The Fed says the flow of new serious delinquencies actually slowed compared to last quarter, but the total share in trouble is still climbing. And here is the line from the Fed report that matters most. The economists wrote that student loan borrowers have, quote, very high delinquency rates across all credit products, end quote. That means people falling behind on student loans are also falling behind on car loans, credit cards, and mortgages. Their payment struggles extend beyond student loans. But the same report also says that, quote, spillover from the recent wave of defaults and delinquencies to broader credit markets is likely to be limited, end quote. So the Fed is saying two things at once. The pain is real for student loan borrowers. The damage so far is contained to that group. And the Fed itself warned in the same report that this relative calm may not hold because outside pressures on consumers are building. The Fed researchers also flagged outside pressures the report did not fully capture. Inflation is up. The latest data shows consumer prices climbing again, driven mostly by fuel costs. Those fuel costs are tied to the war in Iran and the supply chain disruptions it has caused. Lower-income households are getting hit hardest by higher energy prices, according to recent Fed research. The savings rate in this country has dropped from over 6% 2 years ago to around 4% today. That means the average household has less cushion to absorb a shock. None of this is in the household debt numbers yet, because those numbers only run through the end of March, but it is the backdrop for everything coming next. Here is what I learned from over 20 years of watching this kind of data inside the bank. Delinquency reports always lag the real economy. By the time the numbers show stress, the stress has already been there for months. When I would see the quarterly numbers come in, the credit officers I worked with would already know which loans were going bad because they were watching the early warning signs every single week. The customer was already calling to ask about hardship programs. The autopay was already failing. The 4.8% overall delinquency rate is steady right now, but the underlying signals, like rising student loan trouble and inflation pressure on lower-income households, are the kind of things that show up in next quarter's numbers, not this one. So, what does this mean for you, regardless of whether you have student loans? There are 3 early warning signs I want you to watch for in your own finances. Sign 1, your credit card balance is going up month over month, even though you are making payments. That means you are paying interest, not principal. Sign 2, you are using credit to pay for groceries or gas, and then carrying that balance past the due date. That is the inflation pressure landing directly on your credit. Sign 3, you have started ignoring statements or letting them sit unopened. That avoidance is a financial warning sign, not a paperwork problem. Now, if you do have student loans plus other debt, the Fed report says you are in the highest risk group in this country right now. Here is what to do in order. Step 1, log into your student loan servicer's website this week and confirm your current payment status. If you are behind, you are behind. Knowing the number is the first step, even though it is the hardest one. Step 2, if you are in default, look up the rehabilitation program. 9 on-time payments in a row, even small ones, pulls your loan out of default and the default mark comes off your credit report. That is the single most powerful tool you have, and most people in default never learn it exists. Step 3, if you are current on student loans but behind on credit cards, prioritize the student loan. The Department of Education can garnish wages, tax refunds, and even Social Security payments without ever taking you to court. Credit card companies have to sue you first, which buys you time and gives you negotiating room. Step 4, if you are not behind on anything yet, but you can feel the pressure building, call your credit card issuer this week and ask for a hardship program. Most banks have them. Most customers never ask. The worst thing you can do is wait until you miss the first payment. If you want a deeper walkthrough of what wage garnishment actually looks like and how much they can take, I made a video called Wage Garnishment for Credit Card Debt. Here is what they can actually take. That one walks through the federal limits, the state-by-state differences, and the exemptions most people never hear about. Watch that one next if you are worried garnishment is on the table. So, pulling this all together, the Fed report this morning says household debt is stable, credit cards went down, mortgages crept up by a small amount. Student loans are the warning signal, and student loan borrowers are struggling across every credit product they hold. The Fed thinks the damage is contained for now. The same report also shows inflation climbing again, mostly from fuel costs, mostly tied to the Iran war. Lower income households are getting squeezed first. The savings rate has dropped, which means cushions are thinner. None of that is doom. It is just the picture. And the picture says, watch your own numbers carefully this quarter. The Fed numbers come out 4 times a year. Your numbers come out every single day on your phone. If you are starting from scratch or you just want a clean plan for building your credit the right way, I made a video called How to Build Credit from Zero, the 12-month plan a banker would use. Watch that one next. There is a lot more I want to walk you through in the weeks ahead. The Federal Reserve gave us a clear picture this morning. Most of America is steady. A specific group is hurting. Outside pressures are building. Your job is not to panic. Your job is to know your own numbers, watch the warning signs, and take small actions every week. The Fed numbers come out every 3 months. The bank already knows what is happening to your credit in real time. The only way to stay ahead is to know it before they tell you. That is how you build something nobody can take from you. Thank you for watching, and I will see you in the next video.